Welcome to Raising the Brand, brought to you by Private Equity Marketeer. This is where we uncover the stories and strategies of the leading brand builders and capital raisers in private markets. Each episode highlights the creative minds and strategic thinkers who are redefining how private market firms connect with their audiences, build trust, and tell their stories. Learn more at privateequitymarketeer.com.
Welcome back to another episode of our Raising the Brand series here at Private Equity Marketeer. I'm Matt Curtolo, advisory board member here at Private Equity Marketeer and longtime LP. Today we're really excited. We're sitting down with Susan Long McAndrews. Susan is an experienced capital raiser in the private markets. For more than 2 decades, she worked at Pantheon, where she led the firm's global business development platform, served on its board of directors and executive committee, and was deeply involved in shaping how Pantheon engages with investors worldwide. She was also the lead portfolio manager on the AMG Pantheon Fund, a $5 billion private equity vehicle distributed through RIAs and wirehouse platforms. Susan's been at the forefront of efforts to expand access to alternatives from wealth management to defined contribution plans, helping reshape how private markets are delivered to broader investor audiences. Her journey into capital formation is uniquely global, from raising capital in Hong Kong during the early days of Asian private equity to earlier work in Washington, coordinating U.S.-China relations at the Pentagon. So let's get into it. Wow. Welcome, Susan.
Thanks, Matt. Excited to be here.
Absolutely. Quite the background. We're really excited to have you. I think from a background perspective, you've covered a lot of ground, so we're going to hopefully be able to touch on all those pieces in different formats. Most certainly, we spent a lot of time thinking about capital formation at scale, right? Pantheon is one of the most respected global fundraising and investor relations platforms in the industry. So curious to get your perspective. What did you find as you were building that out? Were the key ingredients to building long-term trust with investors across different channels and geographies?
So you just can't substitute for high quality relationships and having local expertise on the ground. So Pantheon was early to the German market, thanks to some early seeds that were sown by one of my partners in Europe. And she advocated early on, we need somebody on the ground, speaks the language, knows how the pension funds work. And we did well there because we had the right person and we were early to market. And that's really a killer combination.
Mm-hmm. It's interesting too, if I ask the time period of that, what were those years when you first entered into those markets?
That was probably 2006, 2007, 2008. Sure. And we were fortunate to land a marquee flagship client initially through our fund of funds starter kit for someone who was new to private equity, but stayed with that relationship as they evolved into separate accounts and then more niche strategies that we could work with them over time.
Gotcha. Yeah, it's certainly a different time. I started my career in privates in 2004, so it was, when I think back 20 plus years ago, it was a different market. What would you say in terms of the approach at that time versus maybe something you did more recently?
Yeah.
Maybe take me back to that period when you launched in Europe, or when you really started to get traction in Europe, and maybe juxtapose it with some of the things you've done more recently.
So it's a really interesting question, Matt. I would say pre-2010, so pre-financial crisis and coming out of the crisis, it was all about expanding geographically. So outside of the US and the UK and Australia, which were really the earlier pioneers in private markets, which geographies were coming online? Where were pensions adding private equity to their allocation? So that took us to Germany, it took us to Japan, it took us to Latin America. And so it was all about taking the same product set in the same channel, but globally. Post 2010, that playbook had pretty much been run, either successfully or not, but there weren't that many new corners of the globe that you could peek into and see a really good market. And so the game really changed to channel. So institutional, we've got that figured out with various degrees of success, but how do we tap individual investors? How do we get to wealth managers? Which markets are most accessible for us to do that. And then insurance was kind of out there as we think it's interesting, but unless we have credit, we're not really quite sure how to tap into it. And credit has really been the tip of the spear for penetrating insurance. So it very much became a channel playbook post 2010. And I'll throw in defined contribution, 401k, and the retirement channel alongside that individual investor. That's a longer story, but that was in the mix as well.
If I hear you correctly too, it's almost a matrix of not just the product offering, but the geography, the penetration level, and sort of the messaging that you have to have in there. So you were juggling quite a bit.
Absolutely.
Yeah. And I guess thinking about that global view, maybe we could just dive into, you did spend time raising capital in Asia just after the Asian financial crisis. So it seems like your timing was good depending on...
Timing was terrible.
Exactly, yes. I mean, thinking about that experience and then all of these sort of emerging areas, what lessons have you learned? Because I think as we talk about raising the brand, sometimes in times like this or in markets where there's less content available, less awareness, you have a bigger hole to fill, so to speak.
Yeah.
Maybe you could speak a little bit to that.
So it's really interesting, I'm sure, for some of the listeners and readers, the Asian financial crisis and raising capital in Asia seems like the dark ages. But I have relationships I made in that chapter of my career that are still highly relevant today. They were people that I grew up with in Hong Kong in the asset class that are now in New York and London and other places. So just a reminder that all of these relationships and connections come back to you throughout your career. What was interesting and challenging at the time, though, Asian private equity was certainly new, but private equity was still new. Yeah. So the main sources of capital were in the US. And so I spent a lot of time on airplanes coming back with investment teams to the US because those were the pension funds that had, a sophisticated enough, mature enough program that they were even thinking about Asian private equity. But that was really the only market with the UK alongside. And so we were dealing with really threading the needle in terms of how to raise capital for that type of strategy.
Yeah, right. And in that case, too, it's not just the strategy, right? You were working for a firm. If private equity was new, if Asian private equity was new, Pantheon as a player would have been new to a lot of these folks. So you also had to think about the brand building piece, which is what I want to spend a little bit time on now. So it's, thinking about building that brand. In this context, what did you do to kind of raise the profile or introduce Pantheon as a brand to some of these markets where they weren't familiar with the asset class and maybe had never heard of the firm before?
Yeah. So if we fast forward to maybe more recent years, the U.S. Wealth Channel, which has been one of my most passionate sort of projects in the last 20 years. It's an interesting challenge because Pantheon is really perceived by many people as a UK brand. London headquarters, British provenance with Ruddy Swire. And so that's been a great brand definition for us, but it has been hard without a lot of spend to build that brand in the US. Frankly, both for the institutional channel and the wealth channel, but I think the wealth channel needs more overt marketing. You generally don't have to market to CalPERS. You go to their office, they get to know you. You go back to their office, they get to know you better. It's a very bilateral relationship build, whereas with the wealth channel, you really do need brand, content, education, name recognition. And so all of that, was a pretty heavy lift.
Well, I can only imagine too that during that era too of just, the institutions get to know you. That world, as we were chatting, is pretty small, right? There are folks who kind of know each other from word of mouth or reputationally or just simply from being an active participant. As you think about the transition, maybe not quite today as we talk about accredited investors and private wealth, and it is the buzzword of buzzwords, but if you think about the early days and some of the channels, the interval fund that you managed to, how did you think about taking what was an institutional, what is and was an institutional brand to those folks? Was it the same motion? Was it a different motion? did you have to build quite a bit more?
Different
was
motion.
fascinated by that.
Yeah, different motion, different vocabulary, different pain points.
Mm-hmm.
So the pain points that you're trying to solve for a financial advisor and his client are tax reporting, simplicity, always open, all of the things that in the institutional channel, they don't really care about. They're used to the fact that you only show up every 3 years and you send them a K-1 in October.
Right.
So the wealth channel was and is a lot about solving different pain points, speaking a different language. And so as you think about your go-to-market, whether it's marketing or salespeople, I'm a big believer in native wealth. So people who grew up in that channel and are just like steeped in it, like it's in their DNA, it's in their network, importantly. Mm-hmm. And so then creating marketing and branding that speaks to that audience, which is very different than, look at me, I'm at Super Return in Berlin. Well, that's that's an institutional forum and sort of tick the box for branding. But for the US Wealth Channel, it's I'm at, Future Proof and networking and posting some innovative content that I picked up along the way to the other advisors that were on the beach at Future Proof, just to use that example.
It's a great example, right? I think that too, and it transcends as we think about media, right? As I always think about how active can you be, how many eyeballs can you see, doing an informal poll of who do people most trust, oftentimes is the people they see on financial news, on CNBC, who's giving interviews, because they're familiar. So building a brand from an institutional heritage into a private wealth does require a different muscle. And I guess the question to you is, what did it mean from a personnel perspective, from a head count, from a team build perspective? Was it a different set of skills or the same people who could pivot? I'd love to learn more about that.
Different set of skills, different background. And again, I use the term wealth native in terms of at least having some people, maybe not everyone, who grew up in that channel and understand it. Ideally also had some private markets along the way. So that's like the killer app is wealth native and private markets fluent. As we all know in the market, that's a rare commodity, and there just aren't enough people yet that have that combination. And then people who are good teachers and can implement an apprentice model in terms of the distribution team. Something you said, Matt, though, really resonated with me in terms of the people you see all the time or the people you trust, or at least for some part of the population, there's that linkage there. And I think personal brand is super important. I mean, look at John Gray. We love following him on Instagram. We love seeing where he's popping up. And then I think last week in DC or wherever this top 100 investor audience was, he delivers some amazing content. And so I do think that we've lost a little bit of that. And I'll use private equity as the example of the founder class, the entrepreneurs who founded Blackstone and KKR and Onyx and Apollo and Leonard Green. Like, those were entrepreneurs. They had that sparkle and that sizzle to start something from scratch that I think is the essence of a great personal brand. And look, there are a lot of asset managers today where like the technocrats are running the show.
Right.
And they didn't build anything. They didn't found anything. They are very talented in some ways, but if you're talking about brand and market positioning, the technocrat isn't the same as that entrepreneurial spirited founder.
I think you're right in saying that too, and where what I can read into that as well is, when you're just starting out, right, you're not dealing with as much, or you don't have access to as many resources. So a lot of this, whether you call it grit or bootstrapping, it's, you have to be resourceful with what you have. And part of that is in the era of consumption from every angle, you have a lot of opportunities to build your brand, and you have to think about it creatively. You have to think about it, a word we use a lot, authentically, right? How does this align with who I am and how I want to be perceived in the world? But then making sure that you do have the ROI, have the throughput on what are we trying to accomplish with this, which, I mean, I'd love to throw it back to you. And how did you go about measuring some of that? Is there standard KPIs as you think about brand building and reach? Is it really just dollars in the door, or is there more that you were able to look at?
Well, certainly dollars in the door is the most tangible. And I think in terms of measurement, being able to measure the success of digital marketing is reasonably tangible. It might not 100% correlate to dollars in the door, but it is giving you some sense of, are people finding what we're saying to be interesting, and are they sharing it? And do we have engagement outside of just our loyal employees who are following our LinkedIn channels? And are we growing that? And I think, people who are willing to take some personal risk in terms of being out there and expressing an opinion. I'm loving what Elisa Woods from KKR has been kind of putting out there on LinkedIn this year, just like saying things that are like super true, but it's a little bit out there, and it's not, the compliance department telling you, okay, here's your 3 points you can say. Right. And so I think to develop both personal brand, which then reflects positively back on the firm, you need people who A, have something to say, and B, aren't afraid to say it.
Yeah, well put, because I think that is the biggest thing, is there's the chains that you're bound with given regulatory, but then there's also the willingness to step out there and the quality of the message, right? So all of that has to tie together. I love it. I feel like this is a topic too that it transcends asset classes. It transcends even where we are now with the onset and really the evolution of product availability to the broader markets. You have to be much more conscious of this maybe than we had to be 10 years ago.
Yeah. I mean, look, nobody wakes up and says, oh, I need a private credit fund today. But they do wake up and say, gosh, I'd like a more predictable income stream. I'd like to know what my cash flow is this year for my investment portfolio, which might lead to, I need a private credit fund.
Yeah.
But asset managers can be so in their little box of, this is my asset class and I'm selling it, versus what's the outcome that the client, especially within the wealth channel, needs. Do they need something that is tax efficient? Do they need something that they are getting that quarterly income experience? So all of the storytelling that I think is one of the great parts about private equity, because it's such a storytelling asset class, to be able to talk about these amazing private companies and the management teams and that founder in Omaha that, maxed out his second mortgage to build this company. Like, there's just so much there. And so storytelling and what's the outcome are much more powerful than, again, do you need a private credit fund today?
Yeah. It's I think too, from an institutional allocator's perspective, my own experience, where you have models, you have numbers, you have a lot that goes into this, where you have optimizers. I can keep throwing out the words, where you get an answer, right? There is an optimal portfolio allocation, but as we expand beyond that, it does require a lot more tangibility, explanation, storytelling. So I love what you just said there, where it is trying to bring that across categories. And I guess the place where I'd love to go next, which is a jumping off point there, and this whole concept of DC plans, right? Of being able to bring this in. It is a massive market. We all know how big the 401k market just in the US is, but you've been a part of those conversations around private equity for a while. I'd love to know from your perspective what the biggest hurdles for adoption are, and what is it really going to take for it to actualize, and for this to appear in mine and my children's and their children's IRAs or 401ks.
Yeah. Great topic. I mean, it is ironically the one place that is most suitable for a decades-long investment program with private equity or other private assets, yet it has been off limits. So yes, I have been at this topic since 2015, when Pantheon was very much an early pioneer, thanks to a gentleman, Kevin Albert, who was running business development at the time and really had the passion, had the vision around this. What surprises me today is you'll still have people say, well, it's illegal, isn't it? No, it's not illegal. There were these technical issues of daily valuation and daily liquidity that for decades were kind of the big barriers. It wasn't that it wasn't allowed, but nobody could figure out, okay, how do you convert a 10-year life private equity fund into something that has daily pricing and daily liquidity?
Sure.
Those technical issues have been solved. They have been solved in large part thanks to the acceleration of these vehicles in the wealth channel, where monthly pricing and daily pricing is now not such a big deal. And liquidity sleeves within these programs can provide liquidity. So we've solved the technical issues, but what we are still lacking is a culture of innovation and risk-taking within those managing 401k plans. And they're not wrong in some cases to not want to take risk because of all of the legal action that's taken place. Mm-hmm. And so I do hope that at the end of the 6-month period since the executive order, there is some sort of safe harbor, ultimately perhaps legislation that gives plan sponsors a more bulletproof feeling of immunity from some of the lawsuits. However, in this country, 401k plans are managed by the HR department. These companies, to the extent they had an investment staff because they had a DB plan, way back when, no longer have that investment staff. And so you are dealing with a counterparty who doesn't want to take risk, isn't in the investment business to begin with, and so is going to need a lot of education, hand-holding, I believe, by the big brands to give them that level of comfort. And I think where the DOL has ended up in a good place around this has to be within a target date fund as the most suitable wrapper for a 401k participant to get private assets.
I love the framing too, because the question I want to ask you too is really it's the dominoes, right? What has to fall first? The executive order's out. The next piece is sort of a safeguard that people feel confident enough to enact what is allowed, right? What has been allowed for a while, but now has a further push. Do you think sort of the supply demand, right? I think that one of the things, if we think about the amount of dollars that could potentially invest, what does that do to the supply and demand dynamics within the market, right? Of the access to top quality assets in a target date fund. What does that look like when you need to deploy tens of billions of dollars into an asset class that has been steadily growing for years? What's the right mix of that? That is a little bit of word salad, but in terms of thinking about who the ultimate arbiter of what goes in where, the quality of those assets, the experience that an investor has on the other side, where do you see kind of those roles and responsibilities falling?
So in terms of what goes where, I think the asset managers who will be creating and delivering the target date funds have a lot of responsibility and weight on their shoulders to do it well, and to do it well in terms of the quality of investments, but also do it well in terms of there's a balance between diversification and safety and, I've got this watered down experience, like why bother?
Right. Mm-hmm.
And so one of my, I don't know if it's a concern, but one of the things I'm watching for is, are we getting the best of private markets, which is private equity?
Sure.
In a way that it actually is impacting outcomes. Matt, the first part of your question was...
No, a little bit more just about the supply, right? Of like
supply, thank you.
The number of, yeah.
Yeah. Look, I think this is going to evolve very slowly. I think we will have some early movers and first movers, and I don't think there will be a rush to the door for this. So I think we have time to watch this evolve before, and I'm not suggesting you were doing this, but before we jump to the other side of the bridge of like, there just isn't enough good private equity left for all these 401k plans, because I don't think even once it becomes widely adopted, I still think there are many companies that just will choose not to for various reasons, or they will choose to do it in a way that is, well, we really only want private credit and private infrastructure. So I think there's a lot of cards still to be played on the table before the supply demand problem is right with us.
Very fair. It's good to hear that too, because I think it's not a today problem. I think if you look at the private markets relative to the global market cap, all of those things, it's still a very small percentage. But when you start to see this level of adoption, I think here in my backyard, if Vanguard took a percentage of a percentage, right, that becomes potentially the biggest buyer of private equity in the world. So, all those considerations, you don't want to use that as a reason not to move forward in something like this, but setting it up and structuring it in a way that you described, where there are safeguards. It's done in a very programmatic way that is not overexposing or bringing in unneeded risk or misunderstood risk. Probably the biggest point.
Exactly.
Great. Well, Susan, I want to pivot a little bit. You were the fundraising aspect of what you did for a lot of your career is, I think something interesting. And on Private Equity Marketeer, we spend a lot of time thinking about the audience here as IR business development professionals. Given that you trained and led a lot of fundraising teams around the world, what are some pieces of advice you'd give to that next generation of professionals who want to make their mark in capital formation?
That's a fun topic. I have loved mentoring many folks over time at Pantheon, so I love that question. Be intellectually curious all the time in terms of what's going on in the industry, what are new product wrappers. Just be intellectually curious about all the evolution that's taking place, because the premium on that level of technical expertise is going up right now in terms of how are funds being packaged for the insurance channel using rated feeders and CFOs. And, there's a real premium on the people that have that understanding. So I would say never stop the learning part of it. Nicely, I wouldn't say pester, but don't be afraid to engage with senior people. And it's a piece of advice I'm giving my sons now who are starting to get to the end of college and enter the workforce of be the kid who walks up to the senior person and say, how was the game this weekend? What'd you do this weekend? Oh, did your kid have a soccer game? And I remember fondly pre-COVID when we had a lot more people in the office in San Francisco, like that mid-20s generation. I loved hanging out with them in the break room because I felt like it was a way for me to be able to get to know them and then be mentors to them. This was not just IR folks. This was across the office, but the kids stood out who kind of had enough confidence to come say, hey, Susan, can you tell me about this? As opposed to I was this super senior person that couldn't be talked to. Mm-hmm. Message there is engage with the senior people.
Yeah. I think that I will add one thing to that. I didn't mean to cut you off, but I think the willingness, the EQ, IQ, when is the right time, to ask questions. You should always be asking questions, but building a bit of an internal filter of just reading the room, knowing who's 100%. Where and what happens. But it is, I do think in the current state, right, with a lot of folks, we still have a much more distributed workforce than we had 5-6 years ago. So I think there's still some of that to be learned.
Yes, absolutely. Mm-hmm. And I guess, I don't know if this reacts to your initial question, Matt, but as you think about team leaders, distribution team heads, and frankly, firm leadership, I think there's this over-index to cultural fit. That sounds a little bit radical because it's like motherhood and apple pie to say, well, we need someone who's a great cultural fit. Sure. No one's going to argue with that. But when you over-index to that, you're kind of saying our culture's perfect.
Right.
Is the culture so good that we can't take a little bit of risk on cultural fit? And you're also not introducing new DNA, new ways of doing things, new personalities obviously are being introduced, but you're kind of leading yourself down this narrower and narrower path of what the firm is good at and not good at. So that's another one of my more, and look, I've made mistakes both ways, but I'd rather on the margin bring in an overachiever who might not be right down the cultural fairway than right down the cultural fairway for a B-.
I think that is 100% the truth in terms of, I always preach diversity of thought, right? We have diversity on so many vectors, but getting people who can push you to think differently, that come from different walks of life, they still need to have the horsepower and the raw skills to be able to do the work and do the job. But I couldn't agree with you more that you can look outside of what could feel like a very narrow set of parameters to find and build a great team. And success begets success. You are around people who are hard workers and doing good things. I feel like that will help rise everyone up.
Yep.
Yeah. Awesome, Susan. Well, we are coming into what we call the bonus round.
Okay,
So
love
a
it.
couple quick questions. The first one is, what's one finance buzzword you'd love to retire?
Oh my gosh. Double click, zoom out. But my least favorite is let's unpack this. I think just because it got so overused.
Yes.
And by the time you have like the senior associates and the associates say, let's unpack this, you're like, okay, it's over.
We're past it. Yeah.
We're past it. I know.
I love it. I think all of those, for me, it's put a pin in it. So I think
Put a
we
pin
can
in
say
it.
that,
Yeah. Yeah.
What is your favorite brand outside of finance and why?
Ooh. I love Nordstrom. Always have.
Sure.
Great service, great return policy. I love Sephora. Like they were the first in that, like you can get any line you need. You probably do know what Sephora is.
Oh, yes, of course.
Okay. I was getting that blank look.
I do a lot of shopping there, not for myself.
Yeah. Yeah. So I don't know. Those are two that I like.
Sure. And last thing, what's one piece of advice you wish you received earlier in your career?
That's a good one. So I think I adhered to the sage advice of like, don't burn any bridges, like all these relationships come back. But I feel like I could have, I moved around a few times in my 20s, which is the upside is that's what took me to the Pentagon, which was an amazing 2 years of my life. But on the other hand, I think I probably should have moved around a little bit less. I was really kind of torn between finance, government service, and what I really wanted to do was asset management, and kind of got into it through the private equity backdoor, so to speak. And so I think maybe stick with things a little bit longer than you might feel you want to kind of see where it goes.
Sure. Great advice, Susan. And this was a great conversation. I think we could probably have covered a lot of other topics, and maybe we will in a future session, but really appreciate you joining us on this latest episode of Raising the Brand.
I enjoyed it, Matt. Thank you.
Awesome.
Appreciate
Thanks
it.
again.